Welcome, everyone. I'm Greg Carson. I'm from Humble Ventures. I'm moderating. So I think what we're going to do to kick off this panel, the panel is about distressed investing and all the claims processes. So let's start this off just by introducing a little bit of background from each of the panelists. I'll give my background at the end, and we'll start with Tom.
Sure. Tom Braziel. Thanks for having me on. I run a distressed investment boutique focusing on all things, and I guess we got involved in crypto starting in 2015 via Mt Gox. We're the largest buyer of claims for many years, and then from there, been involved in almost every crypto insolvency since, and including the current, whatever, sort of basket of cases, Three Arrows, FTX, Celsius, and Voyager, and some also non-customer focused bankruptcies that people don't see much about on the mining and ATM side.
Great.
Good afternoon. I'm Jason New. I'm the co-founder of NovaWulf Digital Management. I've spent probably over 20 years of my career kind of in distressed and credit investing. I kind of went down the crypto rabbit hole about 5-6 years ago and was pivoting my career into digital asset investing with a big focus on kind of digital asset infrastructure. But as I was in the process of doing that, the market fell out of bed and you had multiple companies filing for bankruptcy. So given my experience and some of the experience of our team members, we obviously sort of turned our focus to look at a lot of the companies that were in Chapter 11 and have been buying claims pretty actively over the past, it's almost a year at this point, not quite.
Great. And I'm Greg Carson. I'm the managing partner of Humble Ventures. We started off doing ventures at XPTO. The group's doing secondary investing in venture capital direct. So we're doing, we're the other side of the coin for these guys, where we're investing in venture capital, mid and late stage companies in the crypto space, but we're buying secondaries. So we're buying them from other people that are distressed investors or investors that are looking to liquidate their holdings. So we have some interesting stuff to talk about. To kick it off, we have, both these guys have a ton of experience, both in the space for, from Mt Gox, basically the first distressed situation, and Jason's been in having, Wall Street experience doing this for many years. So I think for this audience, the first thing we should talk about is just what does this mean? What does it mean that you're buying claims, and what is the business of what you're doing? So you want to start with that, Jason?
Sure. So when a company goes bankrupt, they typically go bankrupt because their liabilities exceed their assets pretty significantly, and or they just run out of liquidity. What's happened really in the digital asset space or in the crypto space, it's been both those things. In most instances, the assets materially exceed the liabilities materially exceed the assets, and they generally had a liquidity crunch either because they had demand deposits or they were an exchange and all the money could just come off the exchange. So that's kind of what's happened. Claims themselves, if you think about like a non-crypto oriented company, or really a non-financial services company that goes bankrupt, typically they have, funded debt like bonds and bank loans. Yeah. And that's generally the bulk of the debt in the capital structure, and that's generally what people invest in if you want to make an investment in a distressed company. In the crypto space, none of these companies had funded debt. They have liabilities from customers putting deposits or crypto on their platform. So that is the liability that is there to trade, and we kind of refer to them as claims. And right now, to put it in context, putting even the mining businesses aside that are in bankruptcy, it's about 40-ish billion of claims that are out there, trading to various degrees. The FTX being a little bit over 25% of that, but there's a pretty sizable opportunity here. From a trading perspective. So I'm sure Tom has some stuff to add.
Maybe Tom, could you explain on how do you denominate a claim? Like, how do you buy a whole claim? Is there a segment? Like, how do you come about the valuation of one of these claims? And then we're going to get into the actual claims themselves, but I think just
sure. So, I mean,
theoretically.
The actual work done on valuation is very simple. You're normally doing like a waterfall where you're doing basically spreadsheeting out what you think recoveries will be based on the assets and coming up with values as your best, calling people like yourself and saying, what's this worth, what's that worth, and trying to piece together the asset side and then figure out the liability pool. And then so much of what's interesting about these cases, and hopefully will come out of them, is there's lots of uncertain case law around that. And so people have all kind of baskets of tokens. How's it going to be treated by the bankruptcy courts? Are they going to be in a different jurisdictions? Does it going to matter what the terms of service say? What's going to happen with things that were SAM coins or alt projects that are so alt, maybe they're not worth anything when the bankruptcy is ready to pay out, and so does it get dollarized at the petition date? So there's lots of stuff like that we think about. For the most part, opportunistic or distressed investors are discounting stuff so heavily that I think, well, Seth Klarman, who's a famous guy in traditional distressed and opportunistic investing, would say you're really supposed to be offering liquidity, not taking on risk. And so normally every firm on the planet, and Jason's included, is discounting because they have to, because there is a lot of risk and uncertainty. But you're trying your best. I mean, you're really trying your best to model it out.
Mm-hmm. And you bought the Mt. Gox. You bought some of the Mt. Gox things. Can you tell us just quickly how that's shaped up for you?
Yeah, sure. So Mt. Gox is fascinating. At the time, it was the only game in town. I mean, there was Mt. Gox, and there's a nested docket in New Zealand called Bitcoinica. And those were the really only two major cases. There were a few sort of corner cases that didn't really, weren't full-blown bankruptcy liquidations. But in those instances, that was really now in hindsight, quite simple. It was just fiat and Bitcoin. You didn't have the forks yet, so you didn't have Bitcoin Cash and the other fork. So it's quite straightforward. But the biggest questions there were, what is Bitcoin? Is it currency or is it property? And if it's property, it has different determinations about who gets the uplift in value post-petition, so post-filing. The Japanese court in Mt. Gox didn't actually decide. They kind of punted on the issue and gave the uplift in value to the claimants, as opposed to going back to the equity holders with Mark Capellas and some other minority investors. So that's how that shaped out. The plan's confirmed, and it should pay out, if not this year, next year.
So the plan means that they're getting ready to distribute the money that's left over to you who bought the claim before. Yeah, and the best, just analogous to the American dockets going on now, a plan is just a contract, and that's the way that bankruptcy, attorney would tell you, and it just is like an agreement following the bankruptcy code that lays out the waterfall. Okay. So that's all been approved, versus the cases are going on now where parties and investors and plan sponsors are jockeying to put plans together. Right, the plan hasn't been approved. So, Jason, why don't you tell us how much claims are out there? Like, I think you're first, like, what are the 3 or 4 claims that you're looking at, and like, what is the biggest one? And
sure. So rough numbers, FTX is, call it, 11, 12 billion. Celsius about 5 billion. BlockFi's similar amount, about 5 billion. Just to put it in context. So that would dimension a little bit the size of the claims pool. And then these are trading, every situation is unique. But say, a lot of stuff's trading in the high teens or 20 cents on the dollar. So just to make the math easy, in something like a BlockFi, if the claim is trading at 20, you're effectively creating the asset base. It's 5 billion in claims, trading at 20, you're creating the asset base for about $1 billion. And the people who are selling these claims were people who were participants on the platform, who had put, let's just say they had 3 BTC, at the time it was worth $60,000, they put on the platform and they borrowed 20. And then when BlockFi sort of shut the platform down, they were like, wait a second, that's my 3 BTC. And the courts have said, actually, no, that's not your 3 BTC. That's BlockFi's 3 Bitcoin. And you just have a claim for 60,000 fiat dollars, not a claim for 3 Bitcoin. Oh. You have a claim for 60,000 fiat dollars, because that's what Bitcoin was trading at the nanosecond this company filed for bankruptcy. So that's kind of how, at least right now, all these things are positioned. And each one of these situations is in different stages of its life cycle. Like Voyager is now in the process of liquidating and fairly soon should be distributing out essentially fiat to its customer base. Celsius is in the middle of an auction, which we're bidding in, so I can't really talk about that, but that's sort of got its own timeline. BlockFi is further along and likely to be distributing out sooner, and then FTX is probably early stages, Genesis is early stages. And just one other observation is, what's interesting is a lot of these bankrupt companies have claims against the other bankrupt companies. In some instances, they may be the largest creditor of another bankrupt company. Like FTX is asserting a $4 billion claim against Genesis, to put it in context. So what I think Tom and we have both done well is actually, it's hard to just say I'm looking at one of these in isolation because you have to know what the other one's worth. Right. So you kind of map the whole universe out, and then it gives you kind of a strategic opportunity and a bit of a competitive, moat to what you're doing.
And so,
and just to add on to that, and kind of the whole idea, in my opinion, of when you're distressed, you're basically trying to get assets within that ecosystem cheaply, and they're cheap because there's a lot of hair, there's a lot of unknowns, and a lot of question marks. But what's interesting about crypto distressed as an asset class, twofold. One, you need that opportunistic capital to show up when no one will write checks. I mean, when no one will cut checks and the liquidity is totally sucked out of the system, you need people like Jason to show up and bid and be plan sponsors and stuff like that. So it's interesting to see that this cycle and the crypto cycle. And then at the same time, so that's great for the ecosystem to see.
So you said there's a bidder and there's a plan sponsor. Is that what you just said? I think.
I mean, it depends on the situation.
Right.
Yeah, it's effectively the same thing. A bidder is someone that's, I'm using terms that could be interchanged. A bidder would be someone who's buying an asset. A plan sponsor is buying an asset, but via a plan.
Right.
So he's basically kicking in money for a management contract or to buy a certain asset that he's going to have either a proportionate or majority or minority control of.
So you guys basically are, you guys have either your own capital or funds that you represent, and you're going to buy the claims against these companies as broadly, not specific assets, but the whole thing. And you buy those at a discount. So I can imagine you guys have like some pool of some portion of those claims, and when those are done, for the audience, how do you get paid? Like how does that become an investment for you? Because where are you going to get the money at the end of the day? But I think people that aren't familiar with bankruptcy might be curious, how would I invest in that? Like how does that evolve for you?
Sure. So with respect to, I think most of the crypto companies, the way it's going to play out is, let's just say I buy $1 million claim at 20 cents. So I spend $200,000 to buy that $1 million claim. I then will need to wait. Voyager is a good example because it's happening real time. In the case of Voyager, I wait till the plan, which is just, to Tom's point, is sort of this legal document that says how everything's going to get dealt with. The plan is what they call confirmed by the bankruptcy court, and then shortly thereafter, they distribute out the assets. And those assets can be distributed either, they can all be sold and distributed in fiat. That's one way. They can be distributed in kind in certain instances. But those are really basically, so you essentially have to wait, and then this shows kind of how old school the bankruptcy court is. A lot of people are going to get a check in the mail, and they'll have to take it to a bank and cash it. And in Voyager, one of the iterations of their plan was to distribute out the crypto, and they wanted to distribute out the digital assets to people. So if I'd put one Cardano on the platform, I may, for tax reasons, want to get that auto back, right? And that's not the way it's happening, because the SEC said those are securities and you can't distribute those because you're not registered to do so. So therefore, just sell everything and send checks, not even wire, literally send checks. So that's. I think these things are going to evolve, but right now it's you get a check in the mail.
Did the SEC do that in this process?
In the Voyager process, yeah. Right. And that got appealed from the bankruptcy court in New York up to an appellate level, and basically Voyager had to redo their plan and not distribute crypto in kind, but distribute fiat.
Okay, and have you experienced similar stuff in this? Are you in the same processes?
Oh yeah, we're involved in all the dockets. I mean, in this issue of whether something's a security or not is going to be hard for estate professionals to deal with because they're known for being very risk averse, which makes it even more difficult. I mean, Bitcoin, again, the trustee in Mt. Gox and other things like Bitcoinica and other cases that were early almost had it easy compared to what the mess they've got now.
Okay.
But, you know.
So I guess back to, so the question I asked, and that was like the good build-up, is where does the money come from that's going to pay you? Like, what is it that how are they generating cash?
These companies?
Yeah, these.
So really, with the exception of Celsius and parts of Genesis, because they have operating businesses and they are continuing to run.
Okay.
All the other platforms are basically shut down. So they're just sitting on a pool of assets,
right?
You know, sitting in wallets,
right?
And waiting to be distributed once all the litigation and you know, intercompany issues and entanglements are unwound. And you know, some are more complicated than others. Obviously, FTX is quite complicated. Right. Genesis is reasonably complicated. And you know, they kind of get simpler as you get smaller, but they're just sitting on a large asset base, right?
Yeah, yeah. And so those asset bases. So, as far as I understand, those asset bases include crypto in wallets. It includes what we talked about, what my firm does, which is the venture portfolios.
Correct.
In the same process where they're going after the claims, my firm is looking at the venture investments that they made. So it's not so much of a distressed situation, it's more the distressed investor has some ownership of something that I'd like to own or that we'd like to own, so we go in and target that. And so I guess where I was kind of leading the audience is those companies need to generate cash to pay the claims. And so they're going to do that by, as you said, operating businesses. The venture portfolios they'll sell, maybe to my firm or to companies like mine, and then the money that I buy will go to the bankruptcy manager, and I will go to you guys, or right. Some portion of that, and the brands.
You know, I mean, having spoken to a lot of traditional finance guys that are trying to get into this space, and Jason's like way ahead of the curve on this, is they're trying to get comfortable with the collateral that they own that will be monetized.
Yeah.
So it is a super learning process. I mean, I think there's an institutional imperative. I assume they're younger clients, and they're the younger people in their organization are saying, hey, what are we doing? Why aren't we looking at these? We're supposed to be the best distressed investors on the planet. Why aren't we looking at crypto?
Yeah.
But these are actually very small dockets in the world of larger distressed firms. To be fair.
What percentage of them are actually crypto assets? Because won't those be very volatile? You might buy it now, and it could shoot way up, it could shoot way down. So you need to add that into your analysis, right?
Correct. I mean, and that's what gives a lot of people a lot of pause. Is if you look at what's on the balance sheet. They're inherently volatile assets. You don't know exactly the time frame in which you're going to get a distribution.
Right.
And therefore, you know, you essentially need to price in a lot of that volatility, and therefore you need to buy things really cheap. Could you go out and hedge? You know, like, you know, Wi-Fi's balance sheet at this point is relatively simple. Right. It's basically fiat, big claims against Alameda, and then Bitcoin and ETH. So if you wanted to, maybe there you could, you know, hedge out some of the Bitcoin and ETH risk.
Right.
But even that's expensive. So, but you're right. Yeah, you've got volatile assets. And then with respect to the venture capital books, you know, it's interesting. A lot of these companies probably should not have been doing venture capital in the businesses that they were supposedly running, but they did. Yeah. And now, you know, I think that's
they messed up the venture capital market as well. Right? So they were
well, that's why maybe that's why prices
high.
Went so high. But yeah, but I think what's interesting, and I think your business model is incredible because you know you may be able to acquire a stake in a really high quality company, but do so at a really cheap price because the seller is effectively a forced seller. Yeah.
So in this case, it's exciting for us because I've been in venture capital for a number of years, maybe 10, 15 years. And in early stage, I did secondaries before. And in this case, we have, it sounds like we're distressed, the distressed panel, but when I'm talking to the people that invest in my fund and my co-investors, I'm telling them, like, I'm not doing a distressed investment. I'm doing good quality investment, but I'm buying from distressed investors. So it's like, these guys are massively distressed investors. They're bankrupt. They're as distressed as you can get, and they have to sell to create claims.
Yeah, well, interesting you say that. When you talk to larger distress firms, sometimes they come in and they say, okay, well, if we can buy it for cash and get all the crypto stuff for free, that's fine. And I'm like, no, you have to be like believe in the ecosystem, like as an investment thesis.
Yeah.
And I assume you got, like myself included, like I still want a good price, but there is an underlying, like the ecosystem can't just die. And so that's something that is a reality that I think they're like, oh, I have to underwrite like Bitcoin, like that's hard for me.
Yeah, no, a lot of people just fall back to, what if Bitcoin goes to zero? I'm like, well, then you're going to probably lose all your money.
Yeah, it's not a deal for you.
But, on the other hand, I would argue, you're today in some of these situations, you're creating Bitcoin at, call it $6,000, $7,000. Mm-hmm. So in a way, you're basically buying stuff at 25 or 65 to 75% discounts because of the process complexity and the hair, and we're almost operating in a bit of a null set. There just are not a lot of people who have the background to do the distressed angle and also have a fundamental bias, positive bias on crypto.
Yeah, it's when we were talking backstage about this. It was like, in both of our businesses, the going after these assets, and in mine where I'm going after good companies, but I'm buying other shareholders. The money doesn't go to the company when I buy it. It goes to a shareholder that was a Series A investor, or an angel, or an employee that left, or the CEO just needs some cash. And what we're finding in the space is that what would normally be a very robust marketplace with lots of competitive tension making the price go up, in mine, it's just crickets. There's in the venture space, nobody specializes in secondaries except for us. In the secondaries guys, they don't understand or want to understand the Bitcoin crypto space, so they not bidding on this asset. And I think for you guys, it's similar.
Very similar, yeah.
You guys are bidding on these assets. Normally, how many people are bidding versus in this one?
I was a big creditor in Lehman Brothers, to put it in context. Maybe, there were thousands of buyers, and Lehman traded, to kind of like a 10, 11% return to your expected recovery. Now, obviously, at that point, treasuries were probably 1%, not 5%. So maybe make that 15% in today's risk-free rate environment, although I know everybody out here would say to call treasury a risk-free rate.
It's a Bitcoin conference.
I'm surprised nobody's thrown anything.
How many people here think that treasury is risk-free?
So I'm not saying it's risk-free, but I'm saying let's just use that as a reference point. Here you're talking about not 15 or 20% like in Lehman, but we're talking about 300% type IRRs, and that may mean you're making 3, 4, 5, 6 times your money in a 1 to 2 year period.
So I can't speak so much on the venture secondary side. Yeah. But I think we all have perspective verticals within, right? You're doing your specialty on secondaries. You're kind of doing operating businesses, looking for plan sponsor deals and operating companies. Right. And we're doing edge case claims. I would say to me, when I think of claims, I always think of a spectrum. You have very on the run market pricing that you can go on the marketplaces like an X-Claim and things like that and look up if a home gamer wants to do it. And then you've got very bespoke stuff. They're very bespoke, no one will touch. Yeah. Totally untouchable. And to me that's the most interesting because sometimes you can get compensated so much for it that you're willing to take that. And I assume y'all have similar things in your vertical where you have on the run to way off piece that no one will touch.
Yeah, in those cases you almost don't you don't have to make as big a view on the success of the asset because it's been priced away from. It's just like you say, off piece. It's the market price is off. So we've experienced a couple of those in the venture side where it's a company that I loved back 3 years ago. I wanted to be on the cap table. Maybe I showed up a couple weeks late, so I didn't get a bid, or Jump or FTX or A16 was in there with big checks, and so they crowded out some of the smaller players, and now we're back. But there's so little venture capital chasing the deals. It's like I said, it's you can make a thesis, an investment thesis that's much more conservative. And I guess you guys are the same. Yeah.
Right. I think when you really take a really big step back to 100,000 feet, a lot of human nature, people are momentum investors because people, more dollars pile into the top at the top of any cycle. And, obviously that's not what you should be doing, but it happens in every industry, in every cycle throughout history. Yeah. And, I was here last year and there were 1 million people here. Yes. And the irony is there should actually be 1 million people here this year, because if you believed last year, you should believe about at least twice as much this year, given the price of Bitcoin. And, there's going to be people blow with the wind in the news, media, and everything else, but people are fundamentally positive and constructive. Yeah. This is an unbelievable opportunity.
Right. And the fun part about distressed, I like that. I'm giving that one too. I agree. The fun part about distressed is if you're willing to give up, if you're willing to lock yourself up and take on duration risk, you can find some amazing bargains. I mean, in the claim side, just to walk through each docket, when we buy Mt. Gox, you're basically buying Bitcoin at half price. If you buy Celsius, you're basically buying ETH at maybe a third of the market price. When you buy FTX, you're probably buying Stable and Solana at maybe like a third of the market price. And then Three Arrows, you're buying a basket of venture capital investments.
I guess maybe it's a little uncomfortable for the normal Bitcoiner or crypto person. They're used to having liquidity all the time. Yeah. In our businesses, like, and we raise capital now, we're always raising capital. The investors come and they say, oh, how long do I leave my capital there? It's going to be 7-8 years. Could be, I guess, even longer for you guys.
Most of the cases not, but FTX, we're telling people, don't expect to get your money for at least 5 years. It's super complicated. It may be longer.
Yeah. So you have to be liquid, but it still compounds at maybe even a better rate. Correct. It's just not in and out. You don't have that benefit. So I guess what is your guys' take on the market now? Is there going to be some more claims, opportunities? Do you think there's some more bankruptcies on the horizon now, or have we seen the worst of it? What's your...
Well, I'd say that the two that are the most obviously stressed right now are, the DCG, given its connectivity to Genesis. I don't know exactly where that's going to shake out. And then similarly, Gemini's situation, because, they're owed $800 million by Genesis. So I'd say those are two where there's a degree of uncertainty. I personally think away from that, I think most of the dominoes have fallen, which again is a good thing. And I think absent just some really crazy regulatory situation that just makes it untenable to do business. Right. And then, that's one risk, and then the other big risk is with the halving coming up in roughly a year for the mining companies, at $28,000 Bitcoin, post-halving, unless you have really low-cost power, your P&L is going to be, challenged. Now the counter-argument to that is that means Bitcoin's probably going to go up.
I would say I was like watching Jason's mind go through all the NDAs he's under. He can't talk about. And I would have to do the same thing. Like, is there more distressed? Okay, am I under NDA? Clearly DCG is like the nexus issue with Genesis, and whether a deal gets done, they might have to file strategically just to basically get a deal done. And I think you'll see some of that. So they won't be like systemic bankruptcies, but you will see more of like they're getting sued by a trustee. They need to ring fence this lawsuit and file and get a buyer to show up. Okay.
I have a question. It's more like a process question for you guys. So these are long processes, and you're buying very liquid assets. A lot of them are like it's got Bitcoin, or it's got all these shit coins. Is it possible to influence the bankruptcy process or the plan to consolidate or move assets around? Like, can you somehow influence the court to say, like, listen, sell all these and just buy Bitcoin on the first day of the plan? So that or is that impossible? Does that ever happen? I think in Mt. Gox they were talking about selling all the Bitcoin at one point, and then they decided not to. Or
it's a great question. The answer is yes to a degree, and I think remember, most of the professionals who've been running these cases, the lawyers and the investment bankers, have zero experience unless they were personally involved with crypto.
Right.
So, I mean, I'll tell you as an aside, when I won't say which case, but like day one of one of these cases, like the U.S. government appoints someone called a U.S. trustee in these bankruptcy cases. Mm-hmm. And in one of these cases, the U.S. trustee came in and said, hey, all those currencies, cryptocurrencies you hold, they need to be held at a qualified custodian, which is basically a bank in the United States. Now, I mean, it could be, Anchorage is OCC chartered or NYDIG, et cetera, but it needs to be at a bank. And
they can't do that.
And the interesting thing was, I heard anecdotally the SEC reached out almost immediately and said, stop doing that, because if these are actually currencies, then they're definitionally not securities. So you had, kind of the Department of Justice on one side here and the SEC, and then obviously, that argument was dropped. But I think as the professionals involved now have gotten more familiar with the ecosystem, I think you can try to make some of those arguments. And honestly, in a lot of these cases, the recoveries would have been materially better had they consolidated their digital asset holdings to, I mean, if you'd gone just to Bitcoin, it probably would have been the best result for most of these situations.
So, yeah, so it's all motion practice, so anybody can make a motion. The U.S. bankruptcy courts and almost a lot of insolvency regimes around the world are courts of equity. So anything that brings more equity and more, hopefully, recovery. But there's a lot of business risk in this, and I think that's kind of what so it'd be hard to see. I think from an administrative standpoint, like if you've got 40 coins, and consolidating the top 10, I think you might start some business cases for cashing out small claimants, cashing out certain jurisdictions where you're running up big legal bills to handle it, or custodian some coin that you don't need or something. So I think it's some of that, and it'll have really weird whipsawing action, I assume, for traders in the market. Estates moving around big bulk of coins and things like that. Even the rebalancing of Voyager, I was hearing traders being like, "Oh, what's going on? We're seeing this big rebalancing." And I was like,
a lot of people are watching Celsius's wallets, for example.
Right. And so what you can do is you could kind of go to the court and say, listen, we'd like you to consolidate these into this wallet and convert, these coins into, we want you to convert half of them into stable and half of them into Bitcoin. You make a petition to the court, and then the other bidders, or is that only after you've taken over the plan?
No, that would be after post-plan. It would just be you need to get the other claimants, the other creditors, to support that conclusion as well.
And it's like a majority vote?
No, it's just not, ultimately it's a 2/3 vote.
Okay.
But that in this context, it'd be just, can you get critical mass of support?
So theoretically, if you bought all of the claims, the court would let you kind of do whatever you want while it's sitting there, or no?
You would think yes, but not necessarily.
Okay.
Yeah, they have rules around voting, like how many votes you get, because normally a plan you have to be approved by 2/3 in amount and like 1/2 in number. So if someone owns like a big block, they don't have like a blocking ability. Also, like under 1120, if you're talking about U.S. cases, under 1129. The judge basically has to sign off on anything. And you can do those motions about rebalancing and stuff pre-planned, and it'd be motion practice. Any party of interest would have the ability to object. The issue you got is you have to make a strong business case for it. It's not just like you can do it because you like Bitcoin.
Oh, cool. Cool. We are out of time. So I want everyone to give a big thank you to Tom and Jason, and give a round of applause. I don't know the format. Are we allowed to take a question from the audience, or are we
I think we're out of time.
Out of time?
Yeah.
I think that's it.
All right. Thanks.
Bitcoiners, welcome back to Bitcoin 2023. This is the Bitcoin Magazine live desk sponsored by Marathon. I am joined once again by Grant, James, and Caitlin. Going over to you, Grant, in the midst of the Bitcoin bear market, is the best opportunity a distressed business, or is Bitcoin the better opportunity?
I think the panelists talked about some interesting ideas for investing in distress, but for me, I think this highlights the importance of users holding their own keys. Like that, for me, is the key lesson in all of this. If you're a customer of BlockFi, you held assets in an interest-bearing account, you just found out that those weren't yours. And there might be some interesting ways for investors to look at distressed investing, but that to me was the key lesson.
James, over to you. Are Bitcoin mining businesses great opportunity? Is there too much operational risk in investing in those businesses?
Well, there's absolutely operational risk. As we've seen, there's capital allocation risk, and so as unfortunately, there's been a tremendous amount of pain in this space. But what that's done is it's produced tremendous opportunity. So you're looking for situations where you can buy either some sort of security that's up the capital stack, or that you can have claims on those assets. So even if they do have operational difficulties going forward, you're buying these things at 20, 30 cents on the dollar. And so you've got a lot of leeway as an investor to still make a good return on that, even if they do have problems down the road. And as they were talking about on the panel, you have claims to hard assets.
Yeah, definitely. Going over to you, Caitlin. So they mentioned at the end of the panel, the Department of Justice was talking about trustees moving everything to a qualified custodian. And I think the SEC had to get involved because it particularly provides legitimacy to our industry. What are your thoughts on that?
That was quite the revelation. Anybody who's out there on Twitter, if you could clip that. I think it was Tom who said it. Maybe it was James. And tag Paul Grewal. Coinbase needs to know this, because why would the SEC call the Department of Justice and say, stop talking about a qualified custodian? It's legitimizing all of this. That's a fact that would, I think, be helpful to Coinbase in their situation with the SEC.
Yeah, definitely. Earlier in the panel, also, go back to you, Grant. Is venture capital markets issued or messed up because of fiat money? And is Bitcoin a solution to that issue that they were talking about?
Well, I think in the venture capital landscape, there are some opportunities for distressed investing. You could look at the FTX portfolio. They had an investment, a venture portfolio of roughly 500 companies and $5 billion. Now, the unfortunate thing is that none of that was Bitcoin oriented. And so for distressed investors, there's not really an opportunity to pick up interesting things on the cheap, in our opinion. But you do have some investors who got mixed up with that are now forced sellers, and they might have some interesting assets in the venture world that are worth looking at on a secondary basis.
Definitely. Being Bitcoiners, how do you go about evaluating businesses? So obviously, do you evaluate them on a Bitcoin standard or on a fiat standard? I'll kick that over to you, James.
Well, right. If you're an investor like Grant and I are, you still have investors who are looking at you on the fiat standard, because that's how all of our investments are operating. All of our companies, our portfolio companies, and so you still have to look at that. But long term, everything in our minds is still being based on that long-term Bitcoin solution and that Bitcoin standard. So you know that fiat is constantly debasing. And if you can value long-term in Bitcoin, especially in mining, then I think that you're going to come out exceptionally well in return. So,
final thoughts to you, Caitlin, 20 seconds.
Oh, gosh. This whole question of should you invest in the picks and shovels or should you invest in the underlying is just a constant question. There's more leverage to the picks and shovels typically. So, for example, the miners, just like in the commodities world, right? The gold miners tend to go up by more in rallies in the gold spot price and then down by more. It's just more leverage to the spot price. Tough investment decision, but I'm not giving advice.
Thank you, everyone. We're back to the Nakamoto stage. Remember to stick with us. Thank you.